I took a call recently with an enterprise staffing owner running between $40 and $50 million a month in payroll. This was not a startup. Their systems were solid. Client relationships had been in place for decades. Growth was steady and consistent. But their liquidity structure had not kept up with the size of the business. And that is where discipline separates scale from chaos. Here is what that looked like. They were running $46 million a month in payroll. That means $11.5 million clearing every Friday, no exceptions. At the same time, they had $71 million sitting in receivables across 200 accounts. On paper, the average collection cycle was 47 days. In reality, some paid in 28 days and others stretched beyond 60. Last quarter, two major enterprise clients shifted their payment timing at the same time. That created an $8.2 million delay in collections over 3 weeks. The treasury team was able to cover payroll, but they had to draw down reserves to do it, and it took 4 months to build those reserves back up. The company was never in danger, but a normal payment shift turned into a capital event because the liquidity structure was not built for that level of scale. The opportunity. At this size, liquidity discipline is not just a finance function, it is governance. When receivables convert into cash on a predictable cycle, regardless of when a client decides to pay, you absorb timing shifts without touching reserves. You protect covenant headroom, you protect flexibility. You grow from a position of strength instead of reaction. The risk. When the governance structure lags behind the size of the company, normal variance turns into volatility. You cover payroll, but reserves drop. Operations continue, but strategic flexibility tightens. You get through the quarter, but then you spend the next 2 rebuilding. The business itself is strong. However, the liquidity infrastructure is not aligned with the scale, and the owner becomes the shock absorber instead of the business. The next step, we structured invoice factoring as part of their liquidity architecture. Approved invoices converted into working capital on a predictable schedule. For the first time, a client shifting payment terms did not force a reserve drawdown. It removed timing risk from payroll. So, here's the real question. How much payment variance across your top 20 accounts could you handle right now without touching reserves? If that answer requires you to react instead of absorb, your governance structure has not caught up to your growth. If you want the 2-minute cash conversion cycle check we use with mid-market operators, comment cycle and I will send it to you.